Good day, madam. My name is Pravin Ravindran, and today I will be presenting assignment 2. The two articles that I chose are Corporate Governance Reforms and Shareholders' Confidence in Emerging Markets, a Case of Malaysia, which will be my first article. And my second article is Information Content and Informativeness of the Analyst Report in Malaysia, Evidence from Sharia Compliant Shares. I will be starting my presentation with the introduction of the articles of Article 1 and Article 2. For the first article, Corporate Governance Reforms and Shareholders' Confidence in Emerging Markets, a Case of Malaysia, by Hasib Ur Rahman, Muhammad Yusuf Ibrahim, and Ayub Che Ahmad, which was published on 3rd January 2017 in the World Journal of Science, Technology and Sustainable Development. The second, Information Content and Informativeness of the Analyst Report in Malaysia, Evidence from Sharia Compliant Shares, by Hasanuddin Muhammad Tas Takir and co-authors, was published on 29 January 2020 in the Journal of Islamic Accounting and Business Research. Both journals are peer-reviewed and address real-world business issues. The World Journal of Science, Technology and Sustainable Development focuses on governance and sustainable development in emerging markets, while the Journal of Islamic Accounting and Business Research centers on Islamic finance and Sharia-compliant practices in business. The first article explores how corporate governance reforms affect shareholder confidence and firm performance in Malaysia. The second investigates how informative analyst reports for Sharia-compliant stocks and how these reports influence investor decisions. The first study finds that strong governance, like board independence, boosts investor confidence but faces challenges in consistent application. The second shows that analyst reports impact stock returns through forecasts and target prices, yet often lack qualitative depth. Both highlight the importance of governance and quality disclosures in supporting investor trust in Malaysia's market. Next, I will be presenting the critical review for Article 1. The title of the article, as mentioned earlier, is Corporate Governance Reforms and Shareholders' Confidence in Emerging Markets, a Case of Malaysia. The researchers are Hasib Ur Rahman, Muhammad Yusuf Ibrahim, and Ayub Che Ahmad. Now let's look at the problem. The article clearly presents a practically important problem by examining the impact of the Malaysian Code on Corporate Governance, MCCG 2012, on the market performance of Malaysia's non-financial listed companies. It highlights the need for strong corporate governance in emerging economies, especially after financial crises that erode shareholder confidence. By analyzing how specific governance attributes affect market performance and investor trust, the study provides valuable insights for regulators, legislators, and corporations seeking to strengthen governance and improve economic outcomes. The study investigates how specific corporate governance attributes, such as separate leadership roles, independent board chairs, and a higher proportion of independent directors, affect the market performance of Malaysian-listed companies following the MCCG 2012. It hypothesizes that these traits enhance oversight, reduce agency conflict, and boost investor confidence, leading to a higher share market value. The analysis covers periods before and after the code's implementation to assess its impact on firm performance. The article clearly defines key terms to ensure measurement consistency and align with the research aims. It explains separate leadership structure as having different individuals as CEO and board chair, independent chair as an independent director leading the board, independent directors as their proportion on the board, and share market price as the average share price over 1 year. Now let's look at the review of the literature. The cited sources are relevant and form the foundation of the study, providing empirical and theoretical insights into how corporate governance affects firm performance, especially in Malaysia and other emerging economies. The review is well-balanced and properly focused. It concentrates on corporate governance standards and their impact on firm performance without straying into unrelated topics. It covers both pre- and post-MCCG 2012 contexts, aligning closely with the study's objectives. Most references are recent, primarily from the 2010s and up to 2016, which is appropriate for a study published in early 2017. Older foundational works are also included to support key theoretical perspectives. The literature review is unbiased, presenting a balanced analysis of agency and stewardship theories along with supporting and opposing empirical evidence reflecting an objective approach. Now I will be presenting the design and procedures for the first article. The study used a quantitative methodology to analyze the impact of corporate governance on market performance in non-financial Malaysian listed companies before and after the MCCG 2012 implementation. It is an original study that addresses gaps in the literature by exploring the effects of the MCCG 2012 on governance compliance and market performance in Malaysia. The study employed various statistical tools to analyze the data, including Pearson's and Spearman's correlation matrices to examine variable relationships, the Bruce-Pagan or Cook-Weisberg test for heteroscedasticity, and the Durbin-Watson test for autocorrelation. The generalized least squares random effects regression model was used to assess the impact of corporate governance features on share price, while the Hosman test determined whether to use a fixed or random effects model. These tools ensured the robustness and reliability of the regression results. The study analyzed 150 non-financial Malaysian firms over 4 years, which will be from 2010 to 2014, excluding 2012 to avoid the impact of the MCCG 2012. It divided the data into pre- and post-code implementation periods, which will be from 2010 to 2011 and 2013 to 2014. Data on share price, business size, and governance indicators were collected from data stream and annual reports. Statistical techniques, including regression analysis, were used to assess the impact of the code on governance and market performance. No pilot study was conducted, and the research relied on secondary data without preliminary testing. The study investigates the impact of corporate governance reforms on shareholder confidence using share market price as the dependent variable. It focuses on 3 independent variables, which are separate leadership structure, independent chair of the board, and the proportion of independent non-executive directors. Additionally, 2 control variables, which are board size and firm size, are included to account for other factors influencing market performance. The study aims to assess how these governance factors affect shareholder confidence, as reflected in the market price. The study employed a random sampling technique to select a diverse sample of 150 non-financial Malaysian listed companies from sectors such as consumer, construction, and technology. This approach ensured sectoral diversity while excluding financial companies, which face different regulatory constraints. Data were collected over a 4-year period, 2 years before 2010 to 2011 and 2 years after 2013 to 2014, the introduction of the Malaysian Code on Corporate Governance to 2012, with 2012 excluded to avoid transitional effects. The sampling aimed to provide a representative view of corporate governance practices in Malaysia. Now let's look at the data analysis and presentation for the first article. The study used quantitative statistical methods to analyze the impact of corporate governance changes under MCCG 2012 on share market performance. Descriptive statistics were first used to compare pre- and post-MCCG performance. Pearson's and Spearman's correlation matrices determined relationships between variables. Hypotheses were tested using generalized least squares regression with random effects chosen through the Hosman test. Diagnostic tests, including Bruce-Pagan or Cook-Weisberg for heteroscedasticity and Durbin-Watson for autocorrelation, assessed regression assumptions. All variables such as leadership structure, board independence, and share prices were numerically coded and analyzed using econometric techniques. The study's findings supported its hypothesis, revealing that after the implementation of MCCG 2012, both separate leadership structure and a higher proportion of independent directors had a significant positive impact on share market price. These results confirm that the new governance code positively influenced corporate compliance and market performance. The study acknowledged limitations, notably the short post-code data period, which is from 2013 to 2014, which may affect the generalizability of long-term findings. Although some improvements in governance compliance were observed, they were minor, highlighting the need for continued research and enhancement of corporate governance practices in Malaysia. Now let's look at the conclusions and implication for the first article. The study aimed to evaluate the impact of Malaysia's 2012 corporate governance reforms on shareholder confidence and market performance. It found that separating leadership roles and increasing independent directors positively influenced share prices, aligning with the study's objectives. However, having an independent chair had a negative effect, which was also explored in relation to the study's goals. The study also highlighted that improved corporate governance can enhance shareholder trust and market performance, underscoring its importance for regulators, policymakers, and stakeholders in emerging markets. It emphasized the value of following recommended governance standards for the benefit of both companies and their stakeholders. The study's findings may influence regulators and policymakers to strengthen governance frameworks, encourage corporate leaders to adopt best practices, and guide investors and shareholders in making informed decisions based on governance and market performance links. The study recommended enhancing compliance with governance guidelines, particularly on separate leadership roles and increasing independent directors. It suggested appointing experienced or retired CEOs as independent chairs to improve board effectiveness. Additionally, it called for future research with larger samples and diverse methods to further explore corporate governance issues. Now I will be presenting the critical review for Article 2. To start off, the title of the article is Information Content and Informativeness of the Analyst Report in Malaysia, Evidence from Sharia Compliant Shares. The researchers are Hasanuddin Muhammad Tas Takir, Azhar Muhammad, Nazrul Kamil Mustafa Kamil, and Jarita Dwasa. The problem for the second article is the article identifies a lack of research on the value of analyst reports for Sharia compliant stocks in Malaysia, despite the growth of Islamic finance. Understanding their usefulness is crucial for investor confidence and effective decision-making in the Islamic capital market. The paper aims to investigate the value of information content and informativeness of the analyst report for Sharia-compliant shares in Malaysia. The article clearly defines key terms to ensure measurement consistency and align with the research aims. It explains separate leadership structure as having different individuals as CEO and board chair, independent chair as an independent director leading the board, independent directors as their proportion on the board, and share market price as the average share price over 1 year. The study examines whether the content and informativeness of analyst reports affect the stock performance of Sharia-compliant companies in Malaysia. It tests 15 variables such as financial metrics and report characteristics to determine their individual impact on abnormal returns. The study defines two key constructs: information content, which includes investment relevant data like target price, earnings forecasts, and trading volume, and informativeness, which covers broader financial indicators of a company's health, such as return on equity, earnings per share, and market value ratios. These terms are clearly outlined in a table within the methodology section for easy reference. As for the review of the literature, The study cites highly relevant literature, including foundational works on analyst reports and market impact by Womack in 1996, Asquith in 2005, and Farouk in 2014. It also includes region-specific and Islamic finance studies that align with the study's focus on the Malaysian capital market and Sharia-compliant finance. This study maintains a well-balanced focus by concentrating on the informativeness and content of analyst reports for Sharia-compliant shares in Malaysia, a relatively underexplored area, enabling in-depth analysis without losing focus. The study uses a mix of foundational and recent sources, combining classic works like Womack in 1996 and Bhushan in 1989 with newer studies and industry reports to ensure both strong theoretical grounding and up-to-date relevance in Islamic finance and capital markets. The study presents a balanced viewpoint, citing both supportive and conflicting findings, such as those by Farouk in 2014 and Da Silva in 2013, which question the efficiency of analyst recommendations for Sharia-compliant stocks. It acknowledges the limitations of past research and avoids broad generalizations, maintaining objectivity throughout. As for the design and procedures for the second article, the study employs a quantitative research methodology using panel regression analysis to explore the correlation between factors from analyst reports and the returns of Sharia-compliant shares over a specific period. While the study is original, it is influenced by Farouk's 2014 work on analyst recommendations in the MENA region. Unlike other studies, this research focuses specifically on Sharia-compliant shares in Malaysia, using only analyst reports on these firms, making it a unique contribution to the underexplored field of Islamic finance. The study uses quantitative methods, including panel regression analysis, to examine the link between analyst reports and stock performance of Sharia-compliant shares in Malaysia. It focuses on cumulative abnormal return and uses various financial metrics to assess information content and informativeness. Diagnostic tests ensure the robustness and reliability of the models used. The study collected 657 relevant analyst reports from Bursa Malaysia from 2010 and 2015 and categorized variables into information content and informativeness. It used a market-adjusted return model to calculate cumulative abnormal return and applied panel regression analysis with diagnostic tests for reliability. 15 hypotheses were tested and the FEM robust model was chosen for analysis. No pilot study was needed as the study relied on secondary data. The study categorizes variables into information content such as target price, earnings forecast, and trading volume, and informativeness such as return on equity, dividend per share, and market capitalization. It also considers the number of analysts, number of pages, and number of shareholders as indicators of report detail and company strength. The study used a purposive sampling strategy to select analyst reports from Bursa Malaysia between 2010 and 2015. A total of 850 reports were collected, but only 657 met the criteria: Sharia-compliant companies, clear investment recommendations, consistent activity and listing status, and available financial and stock price data. This ensured a relevant and robust data set focused on Sharia-compliant firms. Now let's look at the data analysis and presentation for the second article. The study used panel data regression analysis with FEM robust as the most suitable model. Based on the Hausman test, cumulative abnormal return was calculated using a market-adjusted model. Diagnostic tests ensured data validity, and hypotheses were tested for statistical significance in the relationship between independent factors and CAR. The study used quantitative data from analyst reports and stock performance measures, including target prices, earnings forecasts, trading volumes, and other financial indicators to analyze their correlation with stock returns. The study found partial support for the hypothesis, showing that some variables like target price, earnings forecast, return on equity, cash flow to price, and sales to price ratio significantly impacted cumulative abnormal return. However, other variables had no significant effect, suggesting that analyst reports may not be fully reliable for predicting stock performance in the context of Sharia compliant shares. The article highlights weaknesses in analyst reports for Sharia compliant shares, noting a low R-square value of 0.79%, indicating poor predictive power. It also points to a lack of qualitative insights, with reports focusing mainly on quantitative data. Concerns about the reliability of analyst recommendations suggest that these reports may not fully convey essential information, advising investors to seek independent sources for investment decisions. Now, let's look at the conclusions and implications for the second article. The study's conclusions align with its objective of examining the value of analyst reports for Sharia compliant shares in Malaysia. The findings show that the information in these reports has limited predictive power on stock returns, highlighting the report's limited effectiveness in guiding investors. The study addresses both managerial and theoretical issues. It suggests that analysts and brokerage firms improve report quality by adding more qualitative insights. It also recommends that institutions like Bursa Malaysia offer incentives, such as the Capital Market Development Fund, to boost analyst coverage of Sharia-compliant firms. The study contributes to the limited literature on Islamic finance and analyst reporting, especially in emerging markets like Malaysia. The study's conclusions impact various stakeholders in the Sharia-compliant investment sector. Investors may seek alternative information sources, while financial analysts are encouraged to improve the depth and quality of their reports. Regulatory agencies can use these findings to advocate for better reporting standards, ensuring analyst reports to provide reliable guidance for Sharia-compliant investments. The study recommends that analysts improve the quality and quantity of information in their reports, especially by incorporating more qualitative insights. It also calls for future research on topics such as earnings forecast accuracy, the qualitative aspect of disclosed information, and the risk profiles of Sharia-compliant firms. This research would enhance investment strategies and contribute to the literature on Sharia-compliant investments. Lastly, I will be presenting the recommendation for both of the articles. Both journal articles offer valuable insights into corporate governance and financial market behavior in Malaysia. The first article assesses the impact of corporate governance reforms on shareholder confidence using clear hypotheses and strong quantitative analysis. The second article examines the informativeness of analyst reports on Sharia-compliant shares, contributing to Islamic finance literature. While it highlights limitations in report predictiveness, it offers important empirical insights. Overall, both studies are well-researched and valuable for academics, policymakers, and investors in emerging markets. The two articles provide key insights into Malaysia's financial market. The first focuses on how corporate governance reforms like board independence and leadership separation enhance market confidence and transparency. The second examines the limited predictive value of analyst reports on Sharia-compliant stocks, urging the need for better reporting standards. Both studies are data-driven and offer practical recommendations for academics, policymakers, and investors. From the articles, I learned that corporate governance reforms such as board independence and separate leadership roles can significantly enhance investor confidence and market performance. I also gained insight into challenges in Islamic finance, particularly the limited reliability of analyst reports on Sharia-compliant shares, due to informational asymmetries. The studies highlight the importance of using robust econometric methods to strengthen research credibility and emphasize transparency. institutional accountability, and context-specific analysis for building effective financial systems. Both studies highlight the need for ongoing reforms in emerging markets. Strengthening corporate governance through board independence and leadership separation can boost investor confidence. In Islamic finance, improving the quality and standardization of analyst reports on Sharia-compliant shares is essential. Overall, continuous improvement and adaptation of financial and governance systems are crucial for keeping pace with global market demands. That is all from my end for today, madam. Thank you very much for listening to my presentation, madam.